Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Imagine you're just sitting at your desk on a random Tuesday, right? You're logging into your standard, completely boring employer 401k portal to check your retirement balance.
That's a totally mundane, everyday task.
Exactly.
Ugh.
But what if I told you that the numbers flashing on your screen were actually dictated by a clandestine handshake between a Pakistani diplomat and an Iranian official over a barrel of oil halfway across the world?
I mean, it sounds completely absurd, right?
Mm-hmm.
Like the plot of some geopolitical spy thriller.
It really does. But today, that hyper-connected chain of events is literally the plumbing of global finance. The little boxes we used to put things in, like politics goes in one box, technology in another, your retirement in a third. Those boxes are completely shattered.
Yeah, they're gone. It forces a total recalibration of how we view cause and effect.
Yeah.
You just can't look at a digital asset chart or a macroeconomic trend in isolation anymore.
No, you really can't.
The wind currents are circling the globe so fast now, and tracing them requires us to look at the entire board all at once.
And untangling that massive web is exactly why you're here with us today. Welcome to this deep dive.
Glad to be here.
So today is April 1st, 2026, and our mission today is to extract the signal from the noise of this really massive, wide-ranging audio source out of the Middle East. It's an episode of a broadcast called Blockchain DXB.
And we are connecting some seemingly impossible dots today.
Oh, absolutely. We're looking at global military negotiations, United States retirement accounts, deep ideological battles in artificial intelligence, and get this, virtual reality libraries in Saudi Arabia.
It is a massive scope.
It really is. Okay,
Yeah.
Let's unpack this, starting with the sheer gravitational pull of the market right now.
Right, because the scale is really the only place to begin here. The capital provides the baseline for everything else we're going to talk about. It's the fuel.
Yeah, the broadcast paints a picture of a market that is just absolutely roaring. The global crypto market capitalization is sitting at a staggering $2.42 trillion.
Trillion with a T. Trillion, yeah.
Yeah.
It's up 1.69% on the day. Bitcoin is trading at $68,042. And crucially, and this is a big one, we're seeing positive ETF inflows to the tune of $69.36 million.
Which is huge.
It's massive. For you listening, those ETF inflows aren't just like a fun statistic that represents sticky traditional Wall Street money actually anchoring itself into the ecosystem. But the broadcast we're analyzing today ties all this palpable market optimism directly to something far outside of a Wall Street trading desk.
Right, they tie it to a military initiative.
Yes, something called Operation Epic Fury.
The narrative pushed by the broadcast builds this very specific causal link. They're arguing that the potential diplomatic resolution of this military operation is the invisible hand driving this surge in digital asset valuations.
Now, hold on. Before we get into the mechanics of that claim, we need to pause and set a hard boundary here.
Absolutely. The source material contains some highly specific, deeply politically charged claims regarding global leaders, military conflicts, the media, all of it. So for you listening, we want to be crystal clear. We are simply reporting the perspective presented in our source material without endorsing these viewpoints.
Right. Our function here is strictly architectural. We just want to analyze the information structure the source is presenting to its audience.
Exactly. We're looking at how these global narratives are being framed. So diving into that framing, the broadcast states that the Iranian president is actively seeking to end the war, provided certain strict security guarantees are met. The narrative alleges that high-level backdoor negotiations are currently happening between the United States, specifically naming Steve Viecock and Jared Kushner, and Iran's foreign minister, Siad Basar Ghattachi.
And there's a broker involved too, right?
Yeah, they claim this entire delicate diplomatic dance is being brokered by Pakistan's Prime Minister, Shehbaz Sharif.
And alongside these geopolitical claims, the source offers a very sharp, highly partisan critique of how information is even reaching the public.
Oh, they go all in on that. The broadcast argues that mainstream media is intentionally misleading the global public due to what they explicitly label Trump derangement syndrome, or TDS.
Wow, okay.
Yeah, they insist that President Trump is the, quote, most transparent president in history, and they actively urge their listeners to just completely bypass traditional news outlets.
So where do they say people should get their news?
They direct their audience to look exclusively at his Truth Social account, the official White House app, and the social media feeds of the Pakistani Prime Minister to get the real updates on these peace talks.
Well, look, regardless of the political framing there, from a purely macroeconomic perspective, what we need to focus on is the economic chain reaction the source predicts if these backdoor peace negotiations actually succeed.
Right, and that chain reaction is entirely built around a sudden, massive supply shock in the global oil market. The broadcast predicts a severe drop in oil prices if peace is achieved.
How so?
Well, they point to a specific scenario where Iran sends 2 ships of oil directly to the U.S. as this sort of geopolitical gesture of goodwill. You couple that with an influx of captured Venezuelan oil, and suddenly the global energy market is just flooded. The cost of a barrel plummets.
Okay, so energy gets cheap.
Really cheap. And here is where they connect the geopolitical chessboard back to that $2.42 trillion crypto market. They claim dropping oil prices will instantly trigger a massive boom for Bitcoin.
Because of the miners.
Right. The logic presented is that industrial-scale crypto miners, who had recently pivoted their massive data centers to run artificial intelligence models, will immediately flood back to Bitcoin mining because energy is suddenly dirt cheap.
Well, the underlying premise there relies on the fact that Bitcoin mining is famously energy intensive.
Yep.
It operates on a proof-of-work consensus mechanism.
Meaning lots of computers solving math problems.
Exactly. Vast warehouses of computers constantly solving complex math to secure the network. The largest overhead cost for those operations, by far, is electricity. So, naturally, cheaper energy drastically increases their profit margins.
Okay, but I have to push back on the reality of that timeline.
Fair enough.
The broadcast assumes a drop in oil prices will instantly bring AI data centers back to Bitcoin. But flipping an AI data center back to a Bitcoin mining farm isn't like changing the tires on a car. It's like trying to turn a high-speed passenger train back into a heavy freight train overnight.
Yeah, the tracks might be the same, but the engine is entirely different.
Exactly. You don't just flip a switch. AI requires specialized GPUs to train models, while Bitcoin requires ASICs application-specific integrated circuits, which are designed to do exactly one mathematical function forever.
And the cooling requirements are totally different.
The cooling, the physical rack space, all of it. So does a sudden dip in energy costs really negate the tens of millions of dollars in structural friction required to switch back?
What's fascinating here is that your skepticism about the physical infrastructure is entirely justified. It is absolutely not a seamless pivot. You're completely right about the hardware friction.
Right.
But if we connect this to the bigger picture, we have to look at the psychological mechanics of macroeconomic stability, rather than just the physical mechanics of server racks.
Oh, I see what you mean.
Yeah, even if the physical miners don't switch their hardware back instantly, geopolitical stability and cheaper global energy inherently and immediately shift macro-level investor confidence.
Because energy prices dictate inflation.
Precisely. The consumer price index is heavily weighted by energy costs. When the price of a barrel of oil drops, it costs less to manufacture goods, less to ship those goods, and less to cool the stores that sell them.
So inflation fears immediately cool down.
Exactly. And when inflation cools down, central banks like the Federal Reserve are much more likely to lower interest rates. And when borrowing money becomes cheap, institutional investors suddenly have this massive appetite for risk-on assets.
Got it. So the narrative of cheaper energy acts as this immediate psychological catalyst for market confidence.
Yes. That economic chain reaction is what those $69 million in ETF inflows are really reflecting.
So the rising tide lifts all digital boats, the macro market finds a safe harbor, and the capital starts flowing. But capital doesn't just flow into the ether, right? It needs pipes. It needs infrastructure.
It absolutely does.
And that takes us directly from the Situation Room to the HR department. The broadcast highlights a proposed rule from the U.S. Department of Labor that could fundamentally alter the concept of retirement in America.
I mean, this is arguably the most consequential development for the everyday listener. The Department of Labor is proposing guidelines that would formally allow alternative investments, which could potentially include cryptocurrencies, to be integrated directly into standard 401k plans.
Think about your own retirement portal at work. Right now, you log in and you essentially pick between a few conservative mutual funds or a target date fund. It's super rigid.
Very rigid, yeah.
This proposed rule change means that in the near future, you could log in and allocate a percentage of your pre-tax income directly to a decentralized digital asset. We are talking about opening the door for 30 million to 90 million Americans to have direct exposure to crypto.
Without ever having to manage a digital wallet.
Yes. Or memorize a seed phrase or understand cryptography.
It is the ultimate normalization of the asset class. But, to your point about pipes, integrating a 21st century decentralized network into a 20th century financial system is not without profound friction. The source outlines several major systemic risks here.
The first being regulatory uncertainty, which is still just a massive dark cloud over the entire industry. Then there's the obvious market volatility.
Right.
I mean, Bitcoin swinging 15% in a weekend is exciting for a day trader, but it is absolutely terrifying if that's the nest egg you're relying on to retire in 5 years.
Oh, for sure.
But the most fascinating risk they highlight is this sort of unsexy, deeply complicated issue of legacy system integration.
Yeah, this is the hidden bottleneck of global finance. You have traditional banking architecture, much of which is literally still running on COBOL.
Wait, really? COBOL?
Yes, a programming language from the 1960s, and you're trying to plug that into a decentralized cryptographic ledger that settles instantly.
How do you make a 1970s mainframe talk to a smart contract? It's like trying to plug a quantum computer into a dial-up modem.
It is. The friction is immense.
But that exact friction is what the private sector is currently racing to solve, which the broadcast touches on when discussing the rapid evolution of stablecoins.
Stablecoins being digital assets that are pegged one-to-one with a fiat currency, usually the US dollar. They offer the speed of crypto without the terrifying volatility you just mentioned.
Right. And the broadcast highlights a company called Better Money, which just raised $10 million, backed by the massive venture capital firm A16's Crypto. Their stated goal is to build a, quote, stablecoin clearinghouse.
Now, a clearinghouse is a critical piece of plumbing for any financial system. It's the entity that stands between buyers and sellers, ensuring that the actual transfer of funds happens securely and instantly.
Let me see if I can translate this for the listener. Is Better Money basically trying to build the Visa network but for stablecoins?
Basically, yeah.
Like acting as the universal translator. Because right now, if a coffee shop accepts a stablecoin on the Solana blockchain, but my digital wallet only holds a stablecoin on the Ethereum blockchain, we can't do business. So is Better Money trying to be the invisible middleman so all these different digital dollars can finally be spent seamlessly like real money?
That is a brilliant analogy, yes.
Yeah.
Interoperability is the final towering hurdle for stablecoins to actually function as an everyday currency.
Because right now it's a mess.
Right now, the ecosystem is deeply fragmented into isolated islands. A clearinghouse abstracts away all of that blockchain complexity.
Oh, I see.
Just like Visa settles a transaction behind the scenes, when you use a card from a tiny local credit union at a massive global retailer in a totally different country, this clearinghouse would settle the stablecoin transaction instantly. The merchant gets paid in their preferred format, you pay in yours, and neither of you ever has to think about the code making it happen.
It makes the technology invisible.
Exactly.
And making the technology invisible is the only way you achieve mass adoption. But let's follow this thread to its logical conclusion. As soon as you have 90 million Americans plugging their 401ks into this system, and you have these incredibly efficient clearinghouses processing millions of everyday stablecoin transactions for coffee and groceries, you suddenly have an unprecedented, almost unimaginable amount of capital flowing on-chain.
Trillions of dollars.
Right, which naturally leads to a massive structural question. How on earth is all of this going to be monitored?
Which brings us to the inevitable collision of blockchain technology and artificial intelligence. You just cannot have trillions of dollars moving globally without an oversight mechanism that can operate at the exact same speed.
The broadcast notes a profound shift happening in the compliance sector right now. Companies like Chainalysis and competitors like TRM Labs are integrating sophisticated AI agents directly into their blockchain tracking platforms.
And we really have to understand the mechanics of this. This is not just a minor software update with a better search bar.
No.
This fundamentally changes the barrier to entry for investigating financial flows.
Because blockchains are public ledgers. They're basically permanent glass bank vaults. Anyone can look inside and see the money moving, but historically, all you saw were these long, confusing strings of alphanumeric characters.
Right, it was just noise to the average person.
You needed to be a forensic accountant or a specialized data scientist to map out a criminal network or track a sanctioned entity. But the source explains that these new AI agents utilize natural language processing. You can literally use simple, everyday English to investigate complex blockchain transactions.
It operates much like asking a chatbot a question. You simply type, show me a visual map of all the wallets connected to this suspicious stablecoin transfer over the last 20 days. And the AI agent instantly parses millions of data points across the public ledger.
Wow.
It traces the unspent transaction outputs and just hands you a neat, readable report. It totally democratizes the investigation process, handing incredibly powerful surveillance tools directly to traditional finance compliance officers and government regulators.
Here's where it gets really interesting. Are we witnessing the death of the cypherpunk dream in real time? If AI can instantly unmask any transaction, does a publicly verifiable blockchain essentially become the ultimate government surveillance tool? Because the broadcast really unpacks this deep ideological clash.
It's a massive clash.
Bitcoin and the broader crypto movement were founded on cypherpunk ideals. We're talking about a fiercely anarchic ethos, strict peer-to-peer privacy, total decentralization, and a financial system existing entirely outside the purview of the state.
Right.
But these new AI tools, they are specifically designed by private corporations to help the state track absolutely everything.
This raises an important question, and I would argue it is the defining tension of the modern digital asset era.
Yeah.
On one hand, you have the genesis of the technology privacy, individual autonomy, resistance to state censorship. On the other hand, you have the absolute necessity of mass adoption. You simply cannot have 90 million retirement accounts and massive corporate stablecoin clearinghouses without robust regulatory security.
Institutional money will not enter a dark forest.
Exactly. Institutional money demands streetlights. It demands anti-money laundering strictures and know-your-customer laws because major banks and pension funds cannot legally interface with anonymous, shadowy entities.
They just can't.
The AI tracking agents are the streetlights. They sacrifice the absolute cryptographic privacy of the original cypherpunk vision in exchange for the transparency and legal compliance required to bring digital assets into the global financial mainstream. It's a fundamental trade-off.
You want your digital rebellion to be worth $2.42 trillion. You have to let the AI read the ledger.
Once the industry accepts that oversight is not just inevitable, but actually required for growth, the focus shifts. It stops being about resisting regulation and starts being about who can design the most attractive functional rules.
Who gets to build the framework?
Right, which explains why the geographical center of gravity for global finance is shifting so rapidly.
Which takes us from the ideological battles straight to the Middle East, specifically Dubai. The broadcast details how Dubai's Virtual Assets Regulatory Authority, or VIR, has just released their new rulebook version 2.1. Dubai isn't just trying to participate in this new economy. They're aggressively positioning themselves as the architects of its future.
They were providing the exact streetlights we were just discussing. The AAR is actually one of the first jurisdictions globally to formally and comprehensively regulate crypto derivatives, specifically exchange-traded derivatives.
And for you listening, derivatives are incredibly complex financial instruments where you're betting on the future price of an asset rather than buying the asset itself. It's highly lucrative, but wildly dangerous.
Oh, incredibly dangerous.
And the broadcast points out that VAR isn't just allowing this. They've implemented highly specific mechanical safeguards. We're talking about strict rules on margin trading, leverage limits, clear liquidation protocols, and this is the big one, the mandatory separation of client funds.
We really have to unpack the mechanics of that last point because separating client funds is the absolute bedrock of financial trust.
Yeah.
In traditional banking, if you deposit $1, the bank lends that dollar out. But in the crypto space, we've seen catastrophic, multi-billion-dollar failures like the collapse of FTX.
Right, a total disaster.
Specifically because unregulated exchanges commingled user deposits with their own highly speculative, risky bets. When the bets went bad and users tried to withdraw their money all at once, the exchange experienced a bank run. The money simply wasn't there.
Because they gambled it away.
Exactly. By formally regulating these complex derivatives and legally enforcing the strict separation of user funds from operational capital, Dubai is essentially building a grown-up playground for institutional capital. They are proving that you can have complex, highly leveraged financial instruments in crypto without it operating like a lawless casino.
Dubai is proving you can architect a highly regulated, safe financial environment for digital assets. But capital is only half the equation for mass adoption. The other half is human knowledge.
Very true.
If you're going to build a completely digital, hyper-connected economy, you need a population that understands how to interact with it. Which perfectly explains why, just a few hundred miles away, the broadcast highlights how Saudi Arabia is completely reconstructing how human beings access information.
It is a phenomenal parallel. Saudi Arabia is aligning its digital infrastructure with its broader Vision 2030 initiative, focusing not just on capital, but on the architecture of education.
The broadcast details a major forum hosted by King Abdulaziz University in Jeddah. The entire focus was on artificial intelligence and the future of libraries. They launched a massive platform called Science Direct. And the numbers here are staggering. We're talking about giving their population instant digital access to 23 million academic articles, 3,000 journals, and 48,000 books.
But the crucial detail here is the delivery mechanism. It's not just a digital filing cabinet or a better search engine. The broadcast connects this vast repository of data directly to Saudi Arabia's vision of the metaverse.
They paint this incredible sci-fi picture of AI-powered virtual libraries. The goal is to create high-fidelity digital twins of massive academic institutions.
Like a perfect 3D replica.
Exactly. So a student anywhere in the world could theoretically access the physical layout of the library. And instead of typing keywords into a search bar, you're interacting with AI avatars, intelligent conversational assistants, who act as your personal guide, physically walking your digital avatar through complex datasets in a three-dimensional space.
It is a complete reimagining of educational pedagogy. It moves learning from a 2D text-based experience to a full 3D spatial experience.
But I do have to push back on the broadcast's definition of the metaverse here. The source actually gets into a debate about whether you need all 5 senses engaged to truly be in the metaverse.
Right.
But think about it. If I'm just sitting at my desk looking at a 3D digital twin of a breathtaking Saudi library on a flat 2-dimensional monitor, and I can't physically smell the old parchment of the books or feel the weight of the wooden shelves under my hands, am I really in the metaverse, or is this just a highly interactive video game for researchers?
It's a very fair critique, and the physical limitations of current hardware are very real. But we have to look at technological immersion as a spectrum, not a rigid binary.
A spectrum, okay.
The true utility of the metaverse, especially in an educational context, isn't necessarily about achieving perfect sensory replication. You don't need to smell the dust on the books for the platform to be revolutionary.
I guess that's true.
What matters is presence, real-time global collaboration, and completely frictionless access. Imagine a medical student in a remote, underfunded rural village. If they can put on a basic headset or even just use a monitor to stand inside a virtual, three-dimensional digital twin of a state-of-the-art JETA research lab, and they can manipulate a 3D model of a complex protein alongside an AI avatar that answers their questions in real time. That is a profound leap forward in human capability. The lack of tactile feedback doesn't negate the immense historical democratization of that knowledge.
So, what does this all mean? When you take a step back and look at the massive web we've untangled today, it is truly staggering. We started by exploring how backdoor geopolitical negotiations and the mechanics of global oil supply could fundamentally dictate energy costs, instantly shifting the psychology of global markets.
Right.
We saw how that resulting macroeconomic stability is opening the door for 90 million everyday Americans to potentially access digital assets through their completely standard 401k retirement portals, utilizing stablecoin clearinghouses to make the technology invisible.
The plumbing we talked about.
Exactly. We explored how that unprecedented flood of institutional capital absolutely necessitates AI surveillance, fundamentally challenging and perhaps ending the original cypherpunk ethos of the blockchain in favor of legal compliance. And finally, we saw how this exact same underlying drive for regulated digital infrastructure is playing out in the Middle East, with Dubai architecting strict financial safeguards and Saudi Arabia using AI to build immersive virtual universities for the globe.
The central, undeniable through line connecting every single one of these seemingly disparate sources is this. The digital frontier is actively, aggressively, and permanently being institutionalized.
The wild days of rogue coders and lawless ledgers are really giving way to Department of Labor rules, compliance clearinghouses, and highly sophisticated AI oversight.
But as we watch these incredibly advanced AI systems become so deeply integrated into our essential infrastructure, it leaves us with a rather profound implication to consider.
Oh.
If AI agents are now sophisticated enough to instantly untangle the millions of complex transactions on a blockchain for government regulators, and AI avatars are acting as our highly intelligent spatial guides in these vast virtual libraries, how long until these AI systems are the ones actually making the financial trades and synthesizing the academic research entirely on their own, leaving human investors and human students completely out of the loop?
Wow. A completely autonomous, hyper-connected digital world spinning at lightning speed while we just watch. It brings us right back to the dominoes falling across the globe. Only now, we aren't even the ones tipping the first piece. Thank you for joining us on this deep dive. We appreciate you being part of the conversation and untangling this incredible web with us. Until next time.